We are now.
Okay, good morning, everyone, and welcome to the investment meeting for June 2024. Please make your introductions for the record.
Stephanie Zimberg, representing Police Commissioner Savon.
Allison Hirsch, representing Controller Brad Lander.
John Dorsey, designee for Controller Brad Lander.
Steve Meyer from the Bureau of Asset Management, we invited participants.
Ryan Berge, representing Mayor Eric Adams.
Kevin Drew, Mayor's Office.
Nadia Fajina, representing Commissioner Nita.
Arthur England, PBA.
Albert Esterno, PBA.
Freddie Winter, PBA.
Rhonda Candace from Wilshire, present by invitation of the trustees.
EC, also from Worcester, present by invitation. Nicole Jambrisi, Police Pension Fund, present by invitation.
Jeffrey Wood, DEA. Victor Swinton, LBA.
Chris Monahan, CEA. Bob Sansky, State Pension Fund, present by invitation.
Kevin Holloran, Pension Fund, present by invitation.
Marietta Deligaris, AXIA, present by invitation.
Timothy Gifford, Police Pension Fund, present by invitation.
Kevin Thomas, Police Pension Fund, by invitation. David Morris, PBA, present by invitation.
Chris McGrath, PBA, present by invitation.
Okay, SBA,
Anthony Borelli, SBA.
Law Department,
I think they're participating later.
okay. Actuary,
Tom O'Hara from the Actuary's Office.
okay. John, I think that's it for us.
Okay, and I'll just note that there are several members of the Bureau of Asset Management that are participating in public session. And in the event that they participate in executive session, we will ask that they identify themselves at that time. So we have only two items on the public agenda. The first is related to the STAR recommendations, but I think before we have any discussion or questions about that, we should have Steve's presentation, and then we can discuss any outstanding questions that people have regarding last month's presentation on STAR. That works for us. So Steve, we'll turn over to you for, and I'm sure will be a brisk pace.
It will be brisk.
Public presentation.
Great. So I'm going to give you a quarterly update on the first quarter of 2024 calendar year. Also, just as a reminder, I know we go through these quarterly updates, we go through monthly updates. We need to continue to focus on what the returns will be longer term at 10 years. So remember, we have those 5 themes that we look at in terms of really driving economic growth, productivity, inflation, public spending, and private investments over the next 10 years. Those themes are demographical changes in terms of the retiring baby boomers, both here and abroad, and the impact on labor markets around the world, deglobalization and friendshoring of supply chains, moving from, say, China back to the United States, Mexico, or those countries near to us, decarbonization and the move to sustainable sources of energy over the next 20 to 50 years. Also, the level of sovereign debt out there is significant in terms of its impact on the cost of capital. Our debt outstanding now is a little over $27.5 trillion. Our annual GDP is about $28 trillion, so we're almost at 100% of parity with debt to GDP, which is significant. And the last one is disruptive technologies, artificial intelligence, and digitization. So, and the impact in the economy, which will be real. And that will be felt sooner rather than later. And the last point around those 5 big drivers of performance around the global economy would be the geopolitical risks associated with other things around the world that are at heightened levels these days. With that, maybe go ahead 1 slide, please, Kate. Just a real quick update. So inflation and the disinflationary trend of the decline in the rate of inflation has slowed both here and abroad. On the next slide, you can see evidence of that. You can see that although the core CPI in black has come down significantly to about 3.4%, the Fed's preferred measure, the personal consumption expenditure core, on the lower right-hand side in yellow is about 2.8%. That's still a little sticky, a little higher than the Fed's 2% target. If you look on the next slide, to the far right, you can actually see evidence of that slowing of that disinflationary trend, of the reduction in inflation levels. More recently, obviously, the United States is in red, and it's kind of flattened out around 2.5 to 2.7, 2.8%. It's also slowed a little bit in terms of Europe and the Bank of England as well. So the economies are doing quite well. Inflation has been stickier than a lot of people expected to see. and that's caused the Fed to be on hold, or at least became to be on hold for a longer period of time. On the next slide, in terms of consistent with a resilient economy, the U.S. labor market remains quite strong. We have a non-farm payroll report from May this Friday. All eyes will be on that report, looking to see if there's a continued slowing in our labor force dynamics here in the state, and will that give the Fed ammunition at some point to cut rates. On the next slide, just a look at where we are. So you can see the participation rate, labor force participation rate in yellow is still below where it was pre-pandemic. And you can see that although that's the case, we still have a relatively low unemployment rate, below 4% at 3.9%. That's also forecasted for May, again, to be released this Friday. But you can see, I mean, the other takeaway from this slide is just amazing level of dislocation in the labor markets associated with the pandemic. On the next slide, U.S. economic growth is slowing, but remains, I can put this in quotes, moderately okay. It's been actually quite resilient, a lot more than resilient than many people thought, given the fact that the Fed had raised rates so aggressively in 2022 and 2023. We do see slowing in, say, existing home sales are lower because of mortgage rates are so high and housing prices continue to be high. And consumer spending and retail spending is also slowing down. On the next slide, I'll look at a 10-year chart of the various economies and the growth rates over time. Again, you can see the significant dislocation associated with the pandemic. And then to the far right-hand side, more of a normalization. I'd say all markets, although it looks like Japan is actually delivering negative GDP growth, it's actually more flattish. So a normalization of growth around the world at still reasonable levels. On the next slide, official interest rate policies have been very steady, but the European Central Bank is expected to cut rates this Thursday. They'll be the first of the major banks to reduce rates. As of this morning, U.S. Fed Fund futures contracts were actually pricing in 42 basis points in cuts by the end of the year. That basically means one full 25 basis point cut and about a 70% chance or 17 basis points of a second cut later in the year. And those numbers are actually up given some slowdown and some slowing in manufacturing released yesterday in the economy. On the next slide, you've seen this slide time and again. It has changed, however. It's subtle. On the far right-hand side on the bottom, you can see that the Bank of Japan has actually moved up its negative 10 basis point rate levels where they've been stuck since 2016. They now have positive official interest rates again. And you can see that up top, the U.S., the ECB and the Bank of England have all been pretty steady. But as I said, the market is expecting the ECB to cut rates this week. The Fed meets next Wednesday, the 12th of June, and is likely to remain leave rates unchanged. On the next slide, long-term government interest rates have been higher and quite volatile year to date. They started the year around 3.85%. They're at about 4.35 as last look this morning. So as yields move up, bond prices move low, and you'll see evidence of that when we go to some of your preliminary performance or your performance for the first quarter reflected there. Credit spreads have actually tightened, and that's on an increased expectation for a soft landing. A soft landing means slowing inflation that slows, the higher interest rate slows inflation enough to not cause a recession, but allow the Fed to start cutting rates. So that's actually been positive for corporate bonds. There's been a stretch for absolute yields as well as, again, expectations of lower defaults associated with a soft landing. On the next slide, I actually adjusted this slide a little bit to reflect where we were during the pandemic. We had a positively sloped yield curve. You can see that in blue on the bottom. That's as of the end of the year, 2021. That's what a curve should look like. Lower short-term rates are lower than longer-term rates. There's usually a term premium associated with investing further out. On the top in red, that's where we are today. So we still have an inverted yield curve. We have about a 42 basis points inversion between 2-year treasuries and 10-year treasuries. That just basically means that the Fed is keeping short rates artificially high, and that the market expects those rates to come down at some point. Let's skip the next slide and go ahead to credit spreads. Credit spreads, you can see on the far right-hand side, have come down. So high yield spreads in orange, a little less than 300 basis points. And credit spreads is just a way of looking at the premium you get paid for investing in corporate bonds of different credit quality relative to the base rates you're going to get in terms of the risk-free rate for U.S. governments. So again, right now we've got about a 300 basis point premium for high yield above those base rates, those risk-free rates. It's actually come down, and as spreads come down, credit spreads come down, actually corporate bond prices go up. And you can see that even in investment grade and white, they're less than 100 basis points, typically at around 110 on average. So really not compelling, but evidence of the fact that there's been a stretch for yield and some level of relief if the economy has been robust. On the next slide, U.S. stocks have been significantly higher this year. We had a tremendous rally in May of around 3.9% for the Russell 3000, which is a broad-based index. Non-U.S. or developed market ex-U.S. has also been quite strong recently as well. On the next page, just a quick look at that. So you can see for the first quarter of 2024, towards the middle of the slide, up top, equities, U.S. Russell 3000 was up fully 10%. And that's off of a long-term 10-year expectations that went into your strategic asset allocation decision-making of 6.7%. So that's a huge rally in a very short period of time. Over the course of the last year, the Russell 3000 is up over 29%. A lot of that has to do with the recovery associated with the dramatic sell-off in 2022 as inflation spiked and the Fed raised rates 500 plus basis points. I'd say the only outlier really is long duration bonds in red pretty consistently, and that's, again, much higher yields relative to where they were last year and the last couple of years. Let's skip the next slide. I've already covered equities. This is an interesting slide. If you look on the far right-hand side, you can see in that far right-hand side column, they're all pluses. And what that indicates is that 10-year U.S. 10-year sovereign debt around the world, the United States is up top, are all higher. Yields have moved higher and bond prices are lower across all those developed markets. And you can look at where we started the year as of this print. Our 10-year U.S. Treasury yields are 53 basis points above where they started. And again, that's why you see red when we look at bonds these days. Let's skip the next slide and go ahead to private equity distributions. Equity distributions have been down. Those exits, meaning that they're actually sales that companies can then distribute the proceeds of those sales, the profits to investors such as yourselves for reinvestment and other things. They're down associated with higher interest rates. It has really kind of dampened the level of activity in mergers and acquisitions in the United States. So there's still a bid-ask spread between where companies are willing to buy other companies and where those sellers might be willing to sell those companies. On the next slide, just a food for thought, a couple of slides here. In terms of private markets, private companies greatly outnumber public companies in the United States. Here, 87% of firms with revenues greater than $100 million per year are still private. And that's one of the reasons why we still think there's so much potential in terms of private equity and the investments that you actually look at and approve in that asset class. On the next slide, another example of the private market opportunities. Small businesses are almost 80% of all job openings in the United States. And you can see on the far right-hand side, those companies with 5,000 or more employees are a relatively small percentage of those openings. More in the same vein in the next slide, employment in the S&P 500 companies is only about 18% of total U.S. employment. Again, which indicates a very robust and significant opportunity in smaller companies, predominantly private companies. Let's skip ahead 2 slides. A look at S&P 500 profits. They actually make up almost 1/2 of all corporate profits in the U.S., which means half come from non-S&P 500 companies, again, smaller, and many of those being private companies as well. Okay, maybe skip ahead 2 slides, more food for thought in terms of where we are in interest rates. The market's actually pricing in higher interest rates for a longer period of time through the end of next year, 2025. And you can see evidence of that on the, sorry, Kate, one more slide ahead. That's it. On the far right-hand side, you can see where rates started out, where they are today, kind of in the middle of that May 2024. And then with the actually expectations come down, it's certainly not as far as they were, as low as they were pre-hiking cycle. On the next slide, another interesting slide that looks at yields are attractive pretty much across the board. These are yields achievable in many different asset classes. So if you look on the far left, those are U.S. Treasury yields. Right now, this is a proxy for 10-year Treasury yields at 4.5%. That's the diamond, that blue, light blue diamond in the middle, relative to where they've been on average over the last 10 years at just 2.1%. And all those diamonds actually represent more yield associated with these investments that will help your performance in the portfolios and power the returns over time. On the next slide, just a look at the maturity wall. You've heard this expression used in the past. This is just a fancy way of saying how much high yield and leveraged loans actually come due for repayment in the next 4 years, about $1.6 trillion. This is another reason why we continue to believe that corporate credit and private credit will still be a great area of investment for your portfolio. Maybe go ahead 2 slides, Kate. This is just a look at default rates for high yield and leveraged loans. You can see that on the far right-hand side, they've moved higher relative to where they were in, say, 2022 at the start of the hiking cycle, but they're still not out of reasonable range in terms of where they are. In fact, for high yield, they're still below 4%. On the next slide, you've heard about U.S. Stock market exceptionalism. This is sort of an example of that. It actually looks at the S&P 500 now is equivalent to about 40% of the global equity market cap. That means if you added the value of all the public companies around the world, the S&P 500 in the States is actually almost 40% of that total. And you can see that's moved up significantly from a little over 22% about January 2010 to where it is today. So again, the run-up in stock prices in the States has been quite significant relative to elsewhere in the world, and that may speak to some relative value opportunities in developed market ex-US and emerging markets. We talked about those major themes on the next slide and demographics and the impact on labor force dynamics. This is actually evidence of what happens over the next 60 years or more. You can look at the aging population and the decline in terms of as baby boomers actually reach retirement and ride off into the sunset. The share of working age population to total population will go down from about 65% now to about 55 or below that over the course of time. Again, this is a many decades process that we're going through, but it will have an impact on, again, labor force dynamics, the availability of labor. As you know, older folks that typically are retired have different spending patterns as well. They're not creating new households, they're not spending on new homes, they're not buying furnishings. So again, implications for the economy. The top, the second line under food for thought actually talks about the potential for secular stagnation, driving interest rates lower over the coming decades, and we'll see how that pans out over time. On the next slide, this is something that I actually believe to be the case, that we've had higher interest rates, again, associated with official rates being raised quite dramatically here and in Europe, for example, on this slide. But expectations that as they start the easing cycle, they don't go back to the zero bound, or in the case of the European Central Bank, negative yields. So we do think you'll see higher for longer, notwithstanding the fact that you may see some interest rate cuts. And again, I think that's positive for the portfolio over time. Next slide, more food for thought. Just to look at almost 40% of U.S. homes don't have mortgages, which is why the interest rate hikes seen recently haven't had as dramatic impact in terms of slowing the economy. In the same vein, looking at the next slide, about over 50% of all mortgages outstanding actually have locked-in fixed rates below 4%. So right now, those mortgage levels below 4% are actually assets for household wealth. And also adds to a reluctance on the part of individuals to sell their homes and then have to refinance if they were to buy a different home, either bigger or smaller, but at a much higher interest rate, around 7%. On the next slide, just a quick look at housing supply. Housing supply shortages is actually pushing house prices higher. That's another reason why we've seen a slowdown in existing home sales is a couple things. Again, the fact that a lot of people locked into fixed rate mortgages below 4%, but with high housing prices, because of supply issues being pushed higher, there's even less of a reluctance to buy, or more of a reluctance to rather move or to buy another home. Okay, moving on to performance, a couple slides ahead, Kate. Yep, one more, that's it. So, again, we should focus always on long-term outcomes. You can see evidence of that on the far right-hand side. You're actually, the total plant's performance in dark blue, relative to your policy performance if you were at your strategic asset allocation weights. And again, we'll get to those over the course of time through pacing plan, and investments over time. But you can see on the far right-hand side, you've been pretty consistent in terms of your outcomes relative to your strategy, relative to some of the public benchmarks out there. And most importantly, your total portfolio has actually performed on average over 5 years. It's delivered a 9% return, which I think is very healthy, particularly given the fact that you have a 7% target hurdle rate. On the next slide, just more evidence of that. You have a 7% return target. That blue line actually evidences if you were to invest money in the portfolio back 10 years ago, where that value would be right now. If it were at 7%, it would be at that red line. So you can see that over the course of time, you've actually outperformed that 7% target. And we hope to continue to do so in the future. Just a couple slides on your net public market returns. Again, net of fees on the next slide. You can see if we look at the 3-month performance for the first quarter, a lot of green on that screen. Again, U.S. equities, as I suggested earlier, as measured by the Russell 3000, was up about 10%. Your performance is similarly up a little over 10%. The challenges has been in anything with duration. So fixed income is actually sold off, associated with higher yields and lower bond prices, and that's evidenced in red, both in the 3-month as well as the 3-year time horizon. But if you focus on the long term, out 5 years, your net returns, again, net of fees, have actually been quite good. On the next slide, we'll look at public access returns. Here you look at 3 months, again, first quarter performance, and pretty much across the board, it's been green or positive outcomes, with the exception of developed market ex-US, where the US has outperformed, and you've had some economies that have been slower to recover. In the first quarter, then there's been a lot of catch-up in the second quarter, which I'll talk about when we go through preliminary performance results. On the next slide, and forgive me if I'm being too quick, if there's any questions, please interrupt. This is actually a slide that we intend to bring to you in more detail over time. We're working on a number of analytical packages. This actually looks at your fees for public markets. And you can see for the first quarter of 2024, you spent about $15 million in fees. And we believe you get good relative value for those fees you're spending, but we need to demonstrate and quantify that. We're working on slides that can actually demonstrate that. But I think the takeaway here is that the average level of fees that you paid on your public market investments to be managed is 17 basis points, and that's all the way at the bottom in that dark gray. So again, we intend to actually be able to provide you with these insights and track them over time, and to actually improve your fee carry and your fee burden by reducing fees over time.
Steve, that 17 basis points is only all the strategies of public markets, correct?
That's exactly right, John. Yep, just public markets. Yeah, we're still working on the analytics around the private markets, which are a little more complex.
So maybe the suggestion is we just change that little gray one to, instead of all strategies combined, all public market strategies combined.
That sounds
Yeah.
good, John. Yep, good point. On the next slide, a look at your net private manager returns by strategy. Here you can see again, in the 1-year section, mostly positive. You had some struggle in terms of core real estate in the private side. Core real estate has actually suffered a little bit because of concerns about office and retail. You happen to be underweight office and retail relative to the Odyssey Index. But again, first quarter performance was still negative. But again, most important, you look at 5, 10 years since inception, it's all green, it's all positive. So again, I think very good outcomes in your private market investments. On the next slide, I'll look at excess returns relative to strategy. These are your public market spreads relative, your private asset returns relative to your public market benchmarks. And if we go maybe to the second line down and look at private equity, you look at, wow, we underperformed by 19%. That's really something. It's not as dramatic as it seems. We had, again, the Russell 3000 was up over 26% in that time frame. Again, a rebound from 2022 sell-off. You still have positive returns in private equity, notwithstanding the fact that the exits have been lower and valuations have been coming down, albeit somewhat slowly. Again, focus on 10-year returns since inception, and they're all green across the board on the far right. And the next slide, I've only got a couple more slides to go through, so please bear with me. This is the slide we put together. We wanted to give you much more insight into the money that you have invested in private assets, both in the ground as well as unfunded. So the assets under management in light gray on these four pie charts actually is the dollar amount you have invested today, and in dark blue, those are the amounts that have been unfunded, the deals that you've approved, but yet the capital hasn't been called yet. So if you look at where you have the money you have in the ground right now, it's about $12.5 billion out of your base. At this time, around $51 billion for this period. It's a little over $53 billion in assets today. You're about 28% of assets in the ground. You can look at that and say, well, this is really interesting. So we have another $6 billion, or almost another 50% that you as a board of trustees have approved that have not yet been called. Aren't we getting over allocated? And the expectation is you'll have a number of distributions that will occur over time. And if you focus on the deals that you've approved, both that are invested today as well as unfunded or the capital hasn't been called yet, the aggregate is about $18.9 billion. So just evidence of how much work you have done as a board in terms of looking at deals and improving deals.
Excuse me. So how long do you think it's going to take for that money to be allocated, or whatever the correct word is?
Yeah. So these are deals. So typically we make investments and pacing plans that will be called over a period of time. So the pacing plans you approve annually are typically 5 years. We actually think there's good reason for OFI or opportunistic fixed income to have be shorter because of the differences in the quicker cash flows. But the money will be called based on when your general partners in, say, private equity or private real estate or infrastructure or opportunistic fixed income see opportunities in the marketplace. So that will occur over the course of years. At the same time, you have distributions. You have income that comes in on a monthly basis from your private credit portfolios, as well as all those portfolios across the board are kicking off income. And then there'll be capital calls. So it's a balancing act. It's based on a lot of assumptions, but we don't think we get to a point where you're over, say, your 35% basket limit. We've managed very carefully around to make sure that we won't be there. But you will see an increase in allocations over time, which is consistent with your strategic asset allocation that you've asked us to manage to.
Does that negatively impact the possibility for returns?
No, actually, it enhances the fact that the assets haven't been called yet and invested.
Right.
We actually think things have cheapened up a little bit, and opportunities have widened out a little bit. In real estate, core and non-core, we still think there's a rich opportunity set. With private equity, because many of your peer investors may have been over-allocated to private equity, they've pulled back a little bit. We had a change in legislation with the basket clause, which kind of puts your portfolio and other portfolios of the New York City retirement system in a really good position because you're allocating into an environment where people are pulling back, which means the opportunities, the returns will be higher over the course of time. That's why when we look at vintage year diversification, we think that now is a good time to continue to put money to work. So we think that's a positive, both in terms of the new deals you'll approve, but also the deals you've already approved that will be called over the course of time. Again, at hopefully more attractive return levels.
So one of the things that you should just touch upon is parking places. So it's replicating that. So theoretically, it's replicating the return as if the assets were invested.
Yeah.
So that means that we are getting interest, if you will.
Oh,
Yeah, it's not sitting in cash, that's the point.
Yeah.
I'm sorry, I think if you're just
Wait, guys. Okay.
Sorry.
So let me give you an example. That's a wonderful question. So the unallocated on the upper left-hand side, for private equity, you can see unfunded, meaning unallocated or not yet called, is about $3 billion. That right now sits in roughly 3,000 stocks. Those are invested in stocks. So when you approve a deal, we actually will take that money, once it's approved, it goes into your allocation, and it's considered an unfunded obligation. It goes into a parking place. So the parking place for private equity happens to be the broad U.S. stock market. It differs as well. So for private credit, it's going to be a mix of high yield bonds and secured loans. And we go into so we do, your money's always invested. It's not sitting in cash.
Okay.
I actually sat on a panel a couple of weeks ago where I won't say who, but one of the gentlemen on the panel was saying that they have a 10% allocation of cash. He said, this is great, we're earning 5.3%, we're all in T-bills and money market funds, it's wonderful. And I had to call it to his attention, I said, that's great, but last year, the stock market, Russell 3000 was up 26%. So even though it looks like you're getting 5.3, and that's above what you were earning almost zero a few years ago, you're still gonna underperform because you'll have that cash drag relative to your allocations that should have been in equities. So that, we're very careful to make sure we don't have too much in cash that will impact the portfolio in a negative way.
Thank you.
No, great question. I'm sorry I didn't answer it correctly. Thank you.
Yeah, you want, that's why I mentioned.
I know. On the next slide, just to look at the rebalancing activities. So we've actually, John Mercersburg and Robert Fang on the public side have done a really outstanding job in terms of rebalancing the portfolios to your new strategic asset allocation targets. On the upper right-hand side, you can see the cash deficit was a $640 million beneficiary. That just means that $640 million went into cash for two reasons: to meet benefit payments during the quarter, but to also meet capital calls associated with those unfunded private market positions that are called over time. And the rest of it is, again, readjusting the portfolio to adhere to your new strategic asset allocation. So, for example, on the left, you can see we're moving money from TIPS, $1.25 billion over to core fixed income and mortgages in particular. You got out of TIPS, you're no longer investing in TIPS directly. So, again, that's just one of the things that we were able to do in the first quarter. And again, we pretty much wrapped up all the rebalancing by the end of the second quarter.
So I think it's one highlight for the board on this, and that's the 640 that goes to cash. To me, it's the reminder, we pay benefits.
Yeah.
Right, we've never missed a benefit payment, we're not planning on ever missing a benefit payment, but when I see that cash, it reminds me that cash is sitting on the cash desk, because it's getting reinvested, but some of that's going out to members that have earned their pension. So, that's, when I look at this, I'm kind of always reminded of the fact we have money going out. So it's not just sitting there earning interest, we're also making payments so that members can take their earned pension and do what they need to do.
You also have money coming in contribution.
Yeah.
And income associated with the investment. John, for public session, that's all I have. Unless there are any questions?
So that concludes the quarterly, I don't know if I see anybody with a question. Oh, I see Brian,
I
I'm
was
sorry.
just wondering if there's any work being done in your office on the question of looking at employment policy and benchmark policy after the new SAA. I just thought we talked about that.
Yeah.
And it feels like I haven't heard a lot about it.
We're doing a lot, I'm sorry to interrupt, we're doing a lot of work, we're doing a lot of analysis in terms of both. Are we benchmarking the returns properly? Do we have the right parking places? I think we could do better in some instances. I'll give you an example, Brian. So, for example, we divested based on your strategic asset allocation and the instruction from the trustees from TIPS. But TIPS is actually one of 4, 5, 6 different components of your parking places for infrastructure. So there, the parking places are no longer valid because we're out of TIPS.
Not surprising.
And we don't want to continue to maintain relationships and pay fees for TIPS management if it's only for the parking
Only
place.
for placeholder, that
Yeah.
makes no sense at all. Yes, I agree with that. I look forward to that effort developing soon. It feels like the drag between the SAA being adopted and that effort is becoming non-ideal.
Yeah, like I said, we've been working on it consistently for the last year.
Good,
And
great.
expectation changing.
Thank
So
you very much.
that is a very good segue to the next topic, which is resources. So, if there's any other questions for Steve's quarterly, we're happy to address those now or at a later point in the meeting. Thank you, Steve, for that presentation. The second item that we had, which was, I guess, technically the first item, but we just kind of moved it as a second item, is a continuation of last month's conversation regarding, the STAR review and the request for additional resources. I think the best way to frame this is, there are really two components to that discussion. One is the, three, okay, two or three. One is the compact itself, which I expect is a project that will probably go into the summer as we really hone in as a board on the things that are important to us and that we'd like to capture. One is the resources question, which I think is the more pressing of the two as we get into the season of new graduates graduating and postings that we'd like to get out in order to get the system back into get into our asset allocation to have the resourcing to do that. And what would you think?
Joint management.
Oh, and the third, which I really can kind of consider part of the compact, but I think it's fair. And the third piece is the concept of whether or not we wanted to go with a joint manager meeting in, in the early part of what I'll call next fiscal year, which is September-ish, right? So those are really the three components. I think it's safe to say, just based on the way that we operate as a board, that the compact and the things that go into that will really be informed by the other two. So I don't think that is the item on the table today, because I do recognize that folks are going to want to look at that with a fine-tooth comb and make sure that what gets approved is in line with the vision of the fund, and that all of the trustees, city and labor, are all on the same page. So I'm willing to put that on the side. The two questions that remain is the comfort level with doing a pilot program for the joint manager meeting, and again, what I think the more pressing issue is the conversation about resources. We are happy to have either one of those conversations today. If there are questions that are just out there that you'd like to have some clarity on, we're also willing to do that today. As much as I'd love to say, hey, let's vote, I'm not pushing for a vote today, as much as I just want to understand if there are outstanding questions, what we could either provide to the board to answer those questions, or just address them even today. I don't know what the mood of the board is, but I recognize that whenever there's a question of resources, people like to just ask questions and understand what it is. So I'll take either one of those topics, recognizing we'll take questions on the compact too. I just recognize that one can lead us down. We probably need a separate meeting just to talk about that.
And John, labor, this side has been discussing the whole project, and we just really need a little more time. It's a big thing to swallow. So we're looking to, table that portion, and I think the joint manager I think we left off, Stephanie brought up a good point, that it would have to be a steady day, so we could put in our schedules, and I'm open to that.
Okay.
I think it would work, but that was a good point, that you just can't have a ad hoc.
That's fine, that is fair, and I'm happy to come to the next meeting with a date that, what I hope would be a date that would work for all five, recognizing that there are 5 retirement systems that would all participate. So I'm more than happy to go back to the calendar and float the date. To your point, it may not be the final date, but at least a working date that we can start with. So I'll take that, and I'll bring you back a date next month, just so we can have that conversation.
It's fine. It might be impossible with 5 systems.
It would
want to work with you,
but nothing is impossible.
Not with you, John.
Any questions? Okay, so I'll come back on the joint manager meeting. STAR, I recognize the compact itself. We'll take a couple of meetings, because I think that there is
Are there any legal issues regarding?
I don't believe that there are, but we would pass it presumably as a resolution of the board. So I expect that people would like to, understand what they'd be agreeing to. What I see it as is, in the current environment,
Well, the city charter governs how these boards are set
No,
up.
no, it's
right?
not about the setup of the
Yeah.
board, it's about what, yeah.
Can I actually just-
Yeah, please.
The compact is not at all about the board structure or board's work. It's basically it's a transparent, representation of the BAM staff's work plan for the year on behalf of the board. So actually, my response to Brian's question was like, if you looked at the draft compact for next year, Brian, there is a bullet point in the draft compact about reviewing parking places and bringing recommendations and updates back to the board as a part of the work plan that the BAM team is working on next year. So the idea of the compact is that right now, there's nowhere where it's written down anywhere what BAM staff is doing on behalf of the board. You know, we all know that the BAM staff is doing investment due diligence and stuff like that, but beyond that, the investment team does a ton of work and sort of like communicated to trustees as appropriate or when asked or at a moment in time. And so the idea here is to have a proactive annual documentation of like, these are the priorities that BAM has this year. And if there are things that trustees want BAM to be looking at, it's an opportunity for trustees to say like, wait, why are you focused on that? We'd rather focus on, we want you to focus on this and you do this and have that conversation. So it's really a BAM work plan document. It has no bearing and should have no bearing on the board governance oversight or the work the trustees do.
Yeah, that's a great point.
We're actually trying to provide more transparency into what we're working on and why we think it makes sense to do this for the portfolios. So some of the estimates we have a workflow of, say, 10 different things that we're working on, trying to reassess where we are in terms of how we manage and position the portfolios across all 5 plans. We actually believe we can generate over $500 million of additional savings for performance on an annual basis. And we want to be able to present that, certainly not in open forum, but to be able to present that to the trustees, what we're working on. We're still doing the analysis. In terms of resources, and again, I hope this isn't inappropriate for me to say, if we had more resources, we can move faster. We're constrained by the number of people we can have allocated to work on these things. And some of it has to do with the fact that we have a number of open positions which have been hard to fill. But we're hoping is if we can get the right team in place and the right numbers, so we can move a lot faster on these things. But
Well, I think on labor side, I think we all agree. No matter how many, if you want to break it down to 2 or 3, you know, from resources to everything, we have a lot of questions. And they're just not going to be, you know, resolved today.
Yeah.
So I think what we need to do is set up further meetings, discuss it more, really go in, you know, deep into this, and then moving forward, we'll discuss it. But right now, I think that would be the way, I think, all labor, we decide that that's the way we would like to move forward.
That's great, that's great. No problem, we had it on the calendar, we wanted to.
And we appreciate
had
it.
the
Thank
council chairman. Okay, so we have no other business in public. So if it pleases the board, I'm gonna make a motion to exit, public session and enter into executive session.
We have a second? Second. All in favor?
Aye. Okay, so. Is the recording off?
You can stop recording.
We're not recording yet.
We're good now.
Okay, during the executive session, the trustees heard from their consultants, BAM, and several managers regarding alternative credit and private equity. In addition, the trustees also discussed a legal matter during an attorney-client privilege session. Votes were taken. The results will be made public at the appropriate time.
Thank you, Kevin. So with that, I will make a motion to adjourn.
Second.
You stand adjourned. Thank you all. So, the recording is.